Welcome again. I am Alaha Gurgani, your Ops and Community Lead at Early Work. For those who are not familiar with Early Work, we are on a mission to reimagine the careers of tomorrow through our content and through the pieces that we put out. And we do this through two paths. To get into more details, it's through our content. So you will see our newsletter that we kind of share our advice on how to break into certain careers. And we also have a free Slack community where you can meet other like-minded people on this path in tech and startups. Tonight's special speaker is Max, who is the co-founder of Next Chapter, an investor at Ultraviolet, and also a very dear friend, a friend of mine that I admire and respect. So really excited for tonight's event. And to kick things off, how you can support us going forward with our events and meetups is that you can refer a friend. And you can do so with the link that I share in the chat below, and share it with a friend to sign up to our community. It's free and it's a journey. It's one of those journeys where you meet like-minded people. And with that, I will pass it on to Max to carry the rest of the presentation. And in the meantime, if you have any questions, feel free to use the Slido link in the chat to ask him. We have 30 minutes dedicated to answer all your angel investing questions. And I'll pass it on to Max to intro himself.
Yo, hey guys, I'm Max. How about let's do who's who in the zoo whilst I share my screen. So what I mean by that is write in the chat if you are closer to someone who is investing in startups or someone who is raising money for your startup. So are you an angel investor or are you a founder? Let's all write in the chat so then I can kind of tailor the presentation based on who we have here. And I'll share my screen whilst that gets going. Cool. So we got both founder, investor, founder. Okay, we got a bit of both. You guys are making my job hard for me. Lovely. Okay, so I will try, and then the way I'll kind of do it is I'll focus on what angel investors look for and kind of how angel investors go about things. And then at the end, I'll add a little appendix around tactics to raise money if you're a founder as well. So what you're going to get today. Why angel investing? And the flip side of this for founders is, what do angels look for, or why are angels investing? Then how angels can get access to deals, how you source deals, what's your angel investing strategy, how do you analyze companies, and then how do you actually structure and run an angel investing syndicate? Because I know we have a lot of those sorts of questions. And then I can do a little how to raise money from angel investors, since we have a surprising number of founders here. Okay, so why listen to me? You shouldn't. And I don't say that flippantly. I literally mean you shouldn't, in the sense that the essence of being an angel investor or founder is being independently minded. So I want you guys to take everything here with a grain of salt, create your own better ways of doing things, and that's why I'm saying you shouldn't. But a more legitimate answer, I've worked in junior levels for very short stints at 4 different stages of VC. So one is Ultraviolet, which is my syndicate. Going from 0 to 1 is Afterwork Ventures. 1 to 100 was a firm called GGV Capital. They're a pretty large fund, have 10 billion under management. I was their only Australian employee, basically scouting and analyzing companies here. And then I did a short stint at Goldman Sachs as well. I was in the private placements team. So basically companies would come to us. We would shop that company around to your Tiger Globals of the world, et cetera, and help build their pitch decks and help them raise. Then I've worked in a few startups. I'm currently building in stealth. I worked at a startup called Downsizer. I run Next Chapter, which you can check out. Check us out, nextchapter.to. And Atomy is another startup I worked in. So that's a little bit about me. Let's get cracking. So let's put in the chat again, why do you angel invest? Or as a founder, why do you think angel investors want to invest in your company? Let's get that going in the chat, and I can have a look at the responses. Anyone? So any ideas why someone might want to angel invest? Massive potential for growth, high returns. Yes, they are two reasons. Any other reasons why someone might want to angel invest in a startup? Yes, interest in startups, feel like they are part of something. Correct. Support founders, impact. Yes, all these are right. So I think like what you guys know, and I don't even have to tell you, is that there are lots of reasons why people angel invest. And if you're a founder, that means that when you're pitching angel investors, you're not just pitching them why your company is going to be the biggest company. You're actually kind of working out what drives this angel investor. Are they doing it to learn from your company? Are they doing it to meet other investors? Are they doing it because they just like love you as founders? Are they doing it for status? So I feel like these are all reasons why angel investors invest. Returns obviously being a very common one, and the one that VC funds care about. So getting access, what I mean by this, so I'll step back a little bit. There are broadly speaking 3 things you need to do as an angel investor. One is you need to source companies. So you actually need to like find the company to invest in. 2 is you need to get access to the company. So even if you've found the company, you might know there's this cool company called Notion, but you still need to have access to investing into the company. And I think this is arguably the most important part for an angel investor. And then like 3, you need to analyze companies, right? So these are like the 3 pillars of angel investing. And then there's working out your strategy, which is kind of like a synthesis of those 3. So I'll get into how do you get access as an angel investor. First off, I'll talk about why access matters. So there's this saying that someone said, I need the extra quote. This is why I use Notion, because it's easy to edit. I don't want to be part of any club that wants me as a member. And applying that to angel investing, you don't really want to angel invest into the company that is like begging you to invest, right? Because that kind of suggests that a lot of smart VCs didn't invest. So what that means is often the best companies, the hottest companies, are actually the hardest to get access to. So if a company is kind of begging you to invest, make sure you're not the sucker. Make sure all the other investors haven't passed. So that's what's referred to as adverse selection. There are 2 main ways to get access. The first is friendship. It sounds trivial, but often the way you get access to invest in a cool company is a friend of yours or a friend of a friend is starting the company and they give you access as a favor. So that's one way to get access. The more like technical way to get access is add some sort of value, right? So how can you add value to a company? One is you can have a network, right? That might be a network of VCs. So you might be able to like help the company raise. You might have a network of like customers that you can like introduce the company to. Another strategic advice, you might be like a head of growth, so you can help them with growth. You might be a community builder like Alaha. So if you angel invest, you can help them run a community. You might be someone who's like, I don't know, very good at performance marketing. So you can help them with that. So what you should kind of work out is like, where can you add value to this company? Because this is, if you're not friends with them, this value add is one of the main ways you're going to get access to invest. This is another way you can add value via distribution. So the angel investing syndicate I run, Ultraviolet, we are comprised of 10 to 20 creators primarily. By creators, I mean like podcasters, bloggers, community builders, basically people who have really big audiences. So our main value when we invest is we just give founders free marketing. So that helps us get access to like competitive rounds. And we recently invested in one that was like super competitive. Founders Fund led it. Keith Treboy is on the board. Jack Dorsey invested. DoorDash CEO invested. And the only way we got access is because we had this like distribution value add angle. So that's getting access to deals, which I think is the most important, which is why I put it up front. Next is sourcing deals. So actually finding companies. I think with sourcing deals, the main, there are a couple ways to do it. One is you know the founder personally. Two is you outbound the founder, so you can actually reach out to a company you see on LinkedIn. Three is, and like an addendum to that is be very curious with companies you see. There's a company I saw on Twitter recently. They released a product demo. They have like 100 followers on Twitter. And I DM the founder asking if they're fundraising, right? Because I thought the product demo was really damn cool. And it turns out they've already got Craft Ventures, so David Sachs's firm investing, NEA investing, which is like a multi-billion-dollar fund, and General Catalyst investing, another multi-billion-dollar fund. I didn't know this. They only have like 50 followers on Twitter, but having that genuine curiosity about products you try is another way to source deals. Another way to source deals is just from your individual network. So work with other angel investors, work with other syndicates, work with VCs and share deals with them. Typically, if you have some sort of value add, going back to this, it's easier to source deals. And the reason why is like, say you're known as the growth angel, the angel that helps people with growth, then a VC might actually refer a company to you that needs help with growth. So having a value add and sourcing deals are also linked. Next up is like work out your strategy. So what I mean by this is there are like two ways of going into it. One is just going blind. You ad hoc just randomly try and deploy money. And like that can work. But I think the slightly smarter way to play it is have a strategy. And where that starts is working out how much money do you want to invest. This is kind of how I think of it as like the minimum to start getting involved in angel investing. So the min check size is 5 to 10K if you're investing with a syndicate. Some people invest a little bit less. Typically, this is like pushing it on the low side, but there are instances where you can invest less. Over however long you're angel investing, let's say 5 years, you probably want at least 20 to 30 deals. That's kind of my view, right? Let's go on the low side. Let's say you're investing 5K in 20 deals. That requires you to set aside 100K over 5 years. So what I'm trying to get at here is don't say you want to angel invest and want to put like 5K into one company and that's it. And the reason why is it's super risky angel investing and therefore diversification matters. There are like 3 instances where diversification matters more. It matters more if you are early stage. If you're investing early stage, that's because the companies are riskier. It matters more if you have less experience. So if you're just starting out, maybe a better game to play is you pick like 40 or 50 companies and you try and invest really tiny amounts. It also matters more if you're facing adverse selection. And remember, adverse selection is like this idea here. I don't want to be part of any club that wants me as a member. Basically, if the company is like really wanting you to invest, maybe that's because you're like the sucker in the room, so to speak. So if you're like Founders Fund, right? So Peter Thiel's fund, you invest across stages, you have lots of experience, and you have zero adverse selection. Therefore, you can invest in 10 companies. If you're a VC that's new to the block, you probably want to invest in lots of companies because all of these points kind of apply. So that's how I think about diversification. If you're less experienced, diversification is particularly useful. So work out your strategy. It's going to be slightly different for everyone. If you really back your analysis, maybe you only want to do 5 companies. And learn first, ramp second. What I'm saying, what I'm trying to get at with this is, let's say you want to invest 10K per deal. Probably don't invest 10K in your first deals, because when you start investing, everything looks like a new shiny object. After you've seen 500 pitch decks, you start to learn like what's good, right? So I think this is always like a useful point. Learn first, ramp second. So this point, do you want to join a syndicate or do you want to invest as an individual angel investor? There are pros and cons of both. So does everyone here know what I mean by a syndicate? I should ask that question. Hands up if you don't know what a syndicate is. Let me see if I can get a gallery view to see all your faces. Okay, yeah, so a couple of people don't know what a syndicate is. So basically, a syndicate is a group of angel investors. So one way of doing it is you sit there as like an individual person and you go to the company as an individual and you invest in the company as an individual. The other way of doing it is you get 10 or 20 or 50 or 100 people together often you pool your money up front and then you all invest together in the company. So that's a syndicate. Other forms of syndicates are like ones you might find in AngelList. So you haven't put together the syndicate yourself, but you can participate. So the pros of syndicates is you get more deal flow, right? Many hands make light work, more eyeballs mean you see more companies. You can often get greater access. My value add plus Jono's value add plus Laha's value add together is like more useful than any of our value adds individually, and therefore you can get better access. You can learn from others. Like when I started angel investing, I was lucky that a US syndicate kind of took me under their wing. This was a few years back. And I learned so much from them. A lot of them were actual like VCs as well. So you can learn from others by being part of a syndicate. You can also invest smaller checks if you're part of a syndicate. It's kind of hard to like put a 1K check into a company by yourself. But if there are like 50 of you putting a 1K check in and you like pull it all together, then that's 50K for the company. So that's another pro of a syndicate. Cons of a syndicate, you have a weaker relationship with the founder. Like often if you're just a syndicate member, you never actually meet the founder or you don't spend as much time with the founder, and therefore you learn a bit less. Fees, some syndicates charge fees. Typically that's like 20% carry, so 20% of your profits, so to speak, and then like a 10% management fee. And then like status, which is an interesting point, but I know a lot of angels who like having their own name on the cap table. They like individually investing because there's like a status component to that. And I think that's why like someone like a Jack Dorsey will invest individually versus part of a syndicate. Okay, there's probably other reasons there as well. So the third part of working out your strategy is, should you have specific investment theses? So I take a couple views to this. I say the most important thing is knowing what is your circle of competence. When people ask me like, do I invest in certain industries? I say no. I invest in all industries that I can understand, right? And there are certain kinds of risks that I want to take on and certain kinds I don't. So a kind of risk I want to bet on is like, is market adoption risk. So answering the question, do consumers want this? It's like Airbnb in the early days or Uber in the early days. They faced market adoption risk, right? So the angel investor was asking the question, does anyone want an Airbnb? Does anyone want an Uber? I think that's like a very acceptable risk for an angel investor to bet on. I think like a risk, is there someone not muted? Sorry. All good. I think like a risk that's slightly harder for an angel investor to take on is technical risk. So an example of technical risk would be, does this biotechnology company have tech that actually works? That's a very hard risk for an angel investor to actually have an opinion on. So for me, that's typically outside of my circle of competence. So those sorts of companies I will often pass on. Now, theses. I think like investment. So does anyone, we can do their hands up again. Does everyone know, put your hand up if you don't know what I mean by an investment thesis. Yep, so we have a couple people. Cool. Quick rundown is you form a view or you form an opinion on a certain industry, right? So a thesis of mine is that low-code tools, not no-code, low-code tools that allow sufficient flexibility and customizability is the future, right? Another thesis of mine is like the company that cracks AI in primary healthcare will be a unicorn company. So you can have like certain theses, right? Your individual views of the future, and they inform two things. One, they inform your circle of competence. What I mean by that is I know a lot about AI in healthcare, and I know a lot about low-code dev acceleration tools because I've spent the time to put together like a thesis about them. So that makes it easier for me to invest in those spaces. Theses also inform outbound. And what I mean by that is if I see a cool company using AI in healthcare, or if I see a cool low-code tool, I will often message those companies and I actively look for those companies. So I think like that's when an investment thesis is useful. Work out your value add. I think that's part of like your strategy as well. And work out like what type of company are you looking for? And what I mean by that, like how early stage do you want to invest? Do you want them to have a lead investor already on their cap table? Are you looking for like a $100 million, the company to become a $100 million company? Or are you looking for the company to become like a $10 billion company, right? 100 million versus 10 billion. Obviously one has more risk. So higher risk, higher reward. So that's kind of how I think about theses. And that also goes into your strategy. Next, analyzing companies. I'm not going to spend long here at all. I'm going to share this document with you. There is a lot of this content online, or like already a lot of people write about this. I don't have a lot of extra discourse to add to the topic. What we can do, I'll leave this open and we can come back to this in question time. If there's any of these topics you are particularly curious about, I can dive into them, but I also will share this document. Maybe I'll tidy it up a bit and then share it after this call. I can share it with the early work team and they can distribute it. What I will focus on is like 3 things quickly. 1 is founder, 2 is market, and then like 3 is idea. There's this debate in angel investing. What matters more, the founder, the market, or the idea? Let's put it in chat. What do you guys think matters more, the founder, the market, or the idea? And we can see what wins. Okay, lots of founders. This is a very Australian response. Market, I think market is, yeah, okay, interesting. Founder, all 3. I'll take all 3, yeah, market, product. Yeah. So there's no like right or wrong answer. You're not going to have, yeah, agreed, Mark. Hey, Mark, good to see you here. All 3. Yeah, so I think like the actual answer is they're all very linked. The best founders choose the best markets and the best ideas. Good ideas are a proxy for a good founder, right? Like a first-time founder, it's kind of hard to tell whether they're a good founder sometimes, but their idea, their product is their resume. The product can show you they're a good founder. So they're all kind of linked. And I think the debate becomes like it's kind of belabored and slightly arbitrary. I think if you have to choose one, though, you do have to choose founder. And that's because like founders pivot on market and pivot on the idea. This is kind of what I found about founders. You guys can have a quick look at the meme. So this is like VCs, like rookie VCs, good but like mediocre VCs, and then like really good VCs. What I've seen is there tends to be like a full circle with VCs coming back to founder. I'll share with you this doc as well on assessing founders. Oh shit, that's not where I meant to go. There we go. Okay, cool. So we can come back to this if there's anything here in question time. I want to leave a lot of time for questions. How to structure an angel investing syndicate, not legal advice. That's point number 1. Point number 2, and I've kept this nice and short, and if you guys want, we can get into it in question time, is a unit trust with a corporate trustee. That's all I'm going to say. We can do question time on that if you guys want, and it's not legal advice. How to raise money from angel investors. I know there are a few founders here, so I will quickly run through this. So again, understand why angels invest. Understand who are the different kinds of angels, right? So ask an angel very quickly, how much do they invest, right? This is an important question. Ask an angel, what sort of value add are they adding? Ask an angel, do they want to see a lead investor? If the angel wants to see a lead investor before they invest, don't waste your time with them until you have a lead investor. Try and work out, are they looking for like a business that can become $100 million business with like a reasonable probability? Or are they only looking for moonshots? Work that out very quickly. Move on if the angel doesn't match your kind of business. There are like hundreds of thousands of angels out there. So like you want to move through angels quite quickly. I think like this is probably the most important thing here, and it's running a fundraising process. You should think of fundraising like you think of sales and marketing for your startup. It's a discrete like business function, and you need to think of it that way. Momentum and hype are everything because investors are mimetic creatures. What I mean by mimetic is people inherit their desires from others. So investor A thinks that a company is valuable because investor B thinks it's valuable. And this is why momentum and hype are everything, right? Another way of putting this is lots of investors copy each other. I've seen some, it's like Elizabeth Holmes. Why did so many people invest in Theranos? Because investors are mimetic creatures. You can search up mimetic theory if you guys want to know more about like the origin of that term. So a couple thoughts here about running a fundraising process. So build connections ahead of time. Get to know 50 angels and 50 investors ahead of time. Yes, this seems onerous, but a top of funnel will help you down the road. Coffee roast, just a small tip I've heard. Get coffee with founders who have recently raised and ask them to tear your deck to shreds. Low stakes pitching. Practice pitching to friends or low stakes angels before you pitch to VCs, right? So maybe if you're fundraising in Australia, go and find some angel investors in the US or the UK or Singapore and pitch them. And the reason why is like, if you screw up, who cares? You can just like never chat to them again. And they probably don't know many Australian VCs. So do some low stakes pitching. Always be pitching. If someone asks you, how are you? That is your cue to start pitching. Sorry if this advice ruins your life, because now you're always trying to pitch. But what I mean by this is you're just planting a seed. Like you're not giving a full pitch. If someone asks you, how are you? You can just be like, yeah, great. I've recently started this company. Really enjoying it. They might not ask more questions. They might ask more questions, and maybe they know a VC who is going to lead you around. This, I think, is a very powerful question. So a lot of people might say, oh, do you know anyone who I should chat with? In my mind, a better question is, do you know one person who might potentially be interested in investing? And I find the one person will probably triple your odds of getting a good reply. Think of fundraising as a marketing process. Optimize for speed. Don't waste time if an angel isn't interested. Try and win angels in 1 or 2 meetings and then move on. Don't try too hard to convince them. It's just like not worth your time. There are too many angels out there. You can like be kind of tactful with your outreach. I have some like investors reach out to me asking for advice. Some ask to just like trade notes and jam over thoughts. Some make really, really big and bold claims. So these are all like kind of tactful ways to outreach as a founder. You'll have this, but this is some lists of angel investors. If you guys can reach out to every angel on here, hats off. That's a big endeavor. Cool. So I'm going to stop there and let's go to question time.
Alrighty, thanks, Max. The questions are already flowing in. And for anyone out there, if you want to ask Max directly your question, feel free to put your name on and we can call upon you to ask. So the first question is, we have so many questions about setting up a syndicate. So the first one is, what are the costs of setting up and running a syndicate?
Yeah. So the biggest cost is going to be your time. It takes a lot more time than you expect. Everyone said that to me, and I still didn't fully internalize it. If you're trying to do a syndicate amongst 5 to 10 friends, you can set that up for $2,000 to $6,000. So that's the cost of setting up a small syndicate. If you're setting up a large syndicate where you try and get lots of investors investing, and you want to like take carry and management fees, you're probably looking at over $100,000 to set it up, unless you're using a platform like AngelList, which we kind of have platforms like that in Australia now. We have Aussie Angels. So they're like one good example of a way that you can set up a syndicate for a smaller amount of money. Shout out Cheryl Mack. She's probably not here, but like awesome human, and Aussie Angels is great.
Sweet. The other question is, how do angels collaborate to find deal flow and invest?
Yeah, good question. I think it's kind of how you chat with a friend, right? Like you meet someone who's an angel investor and you're like, oh, I'll send you some deals. You should probably give first and you should send them some interesting deals. If they find your deals like helpful, or they like the companies, then they'll probably send some back. Some people say they angel invest, but they aren't actually doing much angel investing. So they probably won't have many deals to send you. But yeah, I think it's just like being helpful for each other, actually being curious about companies. Like some people a lot of people angel invest do it because they really enjoy it. That's like a big reason why I do it. So I like just chatting to people about interesting companies. So I don't think there's any magic to sharing deals with angel investors. I think if you can kind of be helpful for each other and also enjoy the process of like chatting about deals, that's kind of how it happens.
Sweet. That sounds great. The other question is, and I think we can pivot it to a different kind of question, which asks, what would you describe your own circle of competence, which you have covered? But I feel like a question for the audience that would be helpful to answer would be, how would you find your circle of competence?
Yes, it's a good question. So I think the first thing is like there are some companies that inherent in their business model we can understand more easily. And that tends to be consumer companies, so companies that are trying to sell to you and me. So like again, Uber or Airbnb. I think like they're within most people's circle of competence to assess because they're trying to create a product that you and me want. So I think like that's one example. I think another example is like look at what you do for work. If you're a lawyer, maybe you have like insight into legal tech. If you're in construction, maybe you have insight into construction tech. So that's another way. Another way is just building circle of competencies. So I didn't know much about like low code and dev acceleration, but then I like learned about it. Let me see if I can find it. Yeah, so what I ended up doing was like I ended up writing, trying to learn about dev acceleration. I thought the space was very interesting, so I tried to like create a thesis myself to learn how to assess low code companies, and this is kind of what I built. And now I think this like wasn't a circle of competence. I'm not a developer by trade, but now I have like lots of questions, really good heuristics for thinking about low code companies, and like when I chat with a low code company, I typically get, oh, whoa, that's a really good question. Oh, whoa, we didn't think of that. And that's just because I put the time in to develop a circle of competence. So I think that's like another way. So summing them up, some companies inherently are ones you can understand. Second, look to like what you already know in your profession. And then third, you can develop circles of competence. It just takes a little bit longer.
I love that. And it's something that you can develop, not something you're born with, which sounds like really awesome. There's a question about which syndicates did you choose to join before you started angel investing? And I guess like for the broader audience, like how do they decide what syndicates to join?
Yeah, so in general, it's hard to join a syndicate without being a sophisticated investor. Now there are like lots of legal ways around that. Personally, I looped in with one in the US. Um, I can give like my story related to that because it might be helpful. So I after high school, I took like a learning gap year, and on it I was like, um, I'd been compiling this list of companies I wanted to invest in one day. I didn't know how I'd invest. And then I came across crowdfunding, which in general is like a pretty shitty way to invest. And one of the companies was raising on crowdfunding. So I put like a tiny, like, I don't know, $500 check in or something. And then what I started doing was I started looking at all these other companies on crowdfunding and just in the comment sections asking really detailed questions, like more detailed questions than anyone else would put. And then someone who ran a syndicate in the US reached out to me and said, "Oh, do you want to kind of invest with us, analyze companies with us?" So I was lucky to do that. And yeah, I learned a lot about, I guess, VC earlier than I should have, just because I put in the time to actually care about it and ask questions on these crowdfunding platforms. And at that time, then I moved from investing on crowdfunding platforms where you have lots of adverse selection to investing with a syndicate. And that was probably my first foray into it. Uh, from there, I didn't really join many other syndicates. I mainly just angel invested myself and then formed my own. You can find syndicates in AngelList. I think like I don't really like them because they take 20% carry and like a 5 to 10% management fee. But AngelList has like pretty good deal flow. There are a lot of companies that have gone through AngelList. And there are also a lot of unicorns that have gone through AngelList. And there are also a few unicorns that have gone through crowdfunding. So that's what I'd say on that point.
Sounds good. There's like a whole theme about the legal side of things when it comes to angel investing, and something that covers it all is how do you deal with accredited investor requirements when setting up your syndicate?
Yeah. I don't know whether this person's in the US or Australia. They're slightly different. I'll focus on Australia, and I'll say like this isn't legal advice. So I'll first say, okay, what is an accredited or sophisticated investor? So in Australia, technically to angel invest, you need to be what's called a sophisticated investor. And that means you either need to have earned 250K for the past 2 years, over 250K, or you need to have at least 2.5 million in net assets. I could have the definition slightly wrong, but it's something like that. Now, there are, broadly speaking, 3 main workarounds to this. The first is something called the 2-20-12 rule. Companies or micro funds are allowed to take $2 million from under 20 investors in a 12-month period. And those investors don't have to be sophisticated. So that's one rule. So if your friend of yours is raising less than $2 million, they can take you if you're not sophisticated. So that's one way. The second way is you can be deemed an experienced investor. So some companies have AFSLs. That's an Australian Financial Services license that allows them to call you a sophisticated investor. So what I mean, let's say you have a platform. Let's say you have a platform that allows you to invest in startups. That platform might have the authority to call you an experienced investor on their platform only. This is an important caveat, on their platform only. And now you can invest in startups on their platform without the sophisticated investor certificate. So what that turns on is really whether the platform has the ability to deem you an experienced investor in its AFSL. Most AFSLs don't have that. The third way to get around a sophisticated investor rule, well, not get around, it's like, it's legal as far as I know. This is not legal advice though. The third way is you're a beneficiary of a unit trust. And the corporate trustee is sophisticated, right? So I'll try and explain that more simply. The way a lot of angels invest is they pool their money together in what's called a unit trust. So they'll invest, say everyone puts in $1,000, 10 people put in $1,000. Now you have $10,000 in this unit trust. In return, you're called a beneficiary, you get units back in this unit trust, right? And then the unit trust invests in the companies. So this is called a unit trust, and this is just a way of pooling investors. Every unit trust has beneficiaries. So that's like all the people who invest, you, me, etc., all the people giving $1,000. And then every unit trust also has a trustee, and the trustee can be thought of as someone who kind of like leads the trust, right? Now, a corporate trustee is a company that leads the trust, so to speak. That's not technical language when I'm saying leads, but that's just a way of intuiting it. So if the company, the corporate trustee that leads the unit trust, or that is the trustee of the unit trust, is sophisticated, then all the beneficiaries need not be sophisticated. Now, what does it mean for a company to be sophisticated? What it means for a corporate trustee, so a company to be sophisticated, is that it is controlled by sophisticated investors. So that's kind of the way around it. You need a corporate trustee that is controlled by sophisticated investors, and therefore the beneficiaries of the unit trust don't have to be sophisticated. Now, the catch is you can't create a managed investment scheme. The second this becomes an MIT or an MIS, you need an AFSL, and that's like another kind of nightmare path. So it gets a little technical. I won't spend too much time on it, but they're broadly speaking the 3 ways that you don't need a sophisticated investor certificate.
Thanks everyone for that question. I've seen a lot of legal questions in the audience Q&A. Just a heads up, this is not a legal advice, so please do your own research, consult your lawyer and all that stuff. But thanks, Max, for explaining that.
Abdullah, I know this isn't legal advice, but it's just as boring. You can leave, but like let's some people care about it.
Let's get to the parts about your experience in terms of like what's been your best and worst investments, and you don't have to name a company or anything. But,
I don't know, because like none of them have realized gains. I guess the best was probably a company called MTech. They're a enterprise SaaS company building tools for central banks to adopt crypto. right? So to help central banks launch central bank digital currencies, sandbox crypto projects, etc. They're particularly selling into like developing nations. So MTech, I invested in them in 2020. In 2020, and like a month or two after I invested, they had an acquisition offer for 15 times the valuation I paid. They turned down the acquisition offer. I would have happily taken the 15x of my money. They turned down the acquisition offer. I don't really know how they're doing now. Like I get investor updates, but it's just like all unrealized gains. So I guess like that's the closest I've been to an exit. I've had like one or two other small exits, but they're just small. I think like any sort of big exit will probably happen in 10 to 20 years from now, because like that's kind of how compounding works. Worst investment, I don't know, probably public market investments, not angel investments. And that's just because you can see when public market investments go poorly, whereas angel investments, they just kind of stagger along and say the companies say they're going all right, and maybe like in 2 years the company won't be around anymore. So I don't know, I'm going to say a public market investment is probably my worst.
Yeah, definitely a long-term game investing. Okay, so we have time for two more questions from the audience. So I'll quickly go through the other ones. So one of the question is, could you run through the basics of how deals are commonly structured, if you haven't already?
As in how term sheets are structured. I guess like I'm guessing that's what you probably mean. So it's typically on an angel investor will invest on a safe note. The safe note will have like a valuation, or should have a valuation cap on it, which is the maximum valuation you will pay. And then it will have like a discount number on it, and the discount is like, let's say the valuation cap is $10 million, right? So you invest in a safe note with a $10 million cap and a 20% discount. Let's say the company goes out and raises next year, and they raise money from VCs at a $20 million valuation. The valuation you get as the angel is $10 million. There are like pre-post money, employee dilution and all that, which is complex. I'm just leaving that aside. Let's just say the valuation you get is $10 million less 20% because you have a 20% discount. So the valuation you're paying is like approximately 8 million. Let's just think of it as 8 million. There are complex little things on the side. That's a safe note. That's the most common way that angel investors invest. When you hear the term of a price round, that means, so the safe note just has a cap, right? The cap on a safe note isn't necessarily the valuation. What might have happened is the company might have raised 5 million and on a $5 million valuation instead of its $20 million valuation. So now as the angel investor, you get your investment at a 5 million valuation rather than 10. So I hope that's kind of clear. That's how a safe note works. It's a really good instrument. You can read more about it online. A lot has been written about it that will do a better job of describing it than I just did.
Sweet. So question is, does a circle of incompetence make sense? Areas where you want to stay away from?
Incompetence, yeah, I think so. Yep.
Yep, cool. That's it. Maybe one more question before we wrap things up. So if anyone has any final questions while we have Max on, feel free to put in the chat or in the questions, in the Slido questions. The last one is, how do you overcome low engagement from other LPs? For example, they don't vote to contribute their skills to help the startups.
Yeah, okay. Also, quickly, guys, if anyone has a question, feel free to like chuck it in the chat, put your hand up, any of that jazz. So how do you overcome members in your syndicate who don't want to help startups?
It's more how do you overcome low engagement from other LPs?
From other, yeah. So I'm guessing by like LPs, you're talking about syndicate members, since we're talking about angel investing, and LPs in a VC fund aren't expected to engage. So I'm interpreting this question as, let's say you're in a syndicate of 10 people and you all are committing to helping a startup. How do you ensure all the 10 people actually help the startup? So like, one, make those 10 people friends. I think if they're friends, they're going to have a bit more buy-in. Two, assess their commitment before you add them to the angel investing syndicate. So don't assess their commitment based on what they say. Assess it based on what they do. Do they have a track record of sourcing deals, helping startups? 3, write in your trust deed something that, or you can even sign on it if you want. You can sign a contract that requires them to help a startup in a very specific way. Now, don't get me wrong, you probably won't be able to have a broad, vague contract, but let's say that person runs a podcast. You could sign a contract with them that if the syndicate invests in a startup, then they will host the founder on their podcast. Like, I know that's kind of tiff. Ideally, you avoid that, but that's like one hard way of doing it, so to speak.
Sweet. We have a question from Ben in the chat. Ben, would you like to unmute yourself and ask your question?
Sure. G'day, Max. Good to see you.
G'day, Ben. Yeah, it's great to hear from you from the other side of the world.
That's it. My question was, you mentioned about like obviously not wanting to appear too desperate to like angel investors and all that sort of thing. So I just wanted to, I guess, ask like how does one balance like wanting a specific angel investor because, you know, they might be, you know, marketplace specific or consumer specific versus, yeah, obviously, you know, not, again, like trying to balance the not looking too desperate when you think that person would be an awesome value add.
Yeah. I think, I don't think I've got any like secrets here. I think it's probably making sure, okay, it's just every subtle communication you're having with them, right? Like when you're on a call with the investor, they can normally tell whether you're like really reaching out to them because you just need the last dollar or whether you're reaching out because you actually want their value add. I think personalized reach outs always do better. So, hey, I'm reaching out because I saw you invested in this company and you have this expertise. I think what you're doing would be really relevant to what we're doing. I think that's always useful, the personalized reach out. I think if an angel asks, have you raised money from VCs yet? I think it's like an interesting point. So the best answer is either yes, or we haven't started raising money from VCs yet. And I think you can always answer like one of those two answers. Even if you've kind of tried to raise money from VCs, I think you can say, yeah, we explored it with VCs for a bit. I don't know. Ideally, you want to say like, yes, we've raised money from VCs, or we're deliberately deferring raising money from VCs until like 6 months from now and have a reason for that. Yeah. Like I will often, Ben, maybe just provide a bit more context. Like I will often ask founders who reach out like, oh, how's it going? Have you chatted with VCs? Have you raised money from VCs? And like, I think the response that's really bad is, yeah, we've chatted to heaps of VCs. We couldn't really raise them. They said we were a bit early, so we've decided to go with angels. And a lot of people give that response, like an insane amount. So that's the response you don't want to give. But I'm sure you're like all on top of that already.
Easy, bro. Thank you, mate.
No, all good, man.
Ben, for your question. We have one more question from Hannah. Hannah Pham, would you like to unmute yourself and ask your question?
Yeah, sure. Hi, Max. Thank you for taking the questions. When angels are investing in a syndicate and charge a carry fee, like deal by deal, let's say if an angel made a bad investment that's being bared by other angels, how would this, I suppose this angel be punished or kept accountable?
Yeah, you need some voting mechanism in the syndicate, ideally. So if you've pulled, say, 100K upfront in your syndicate, like with 20 investors, so everyone's invested 5K, one investor shouldn't be able to just like go out and invest that money, right? You probably all need like some sort of consensus mechanism. So you just like vote on which companies you invest in. So I think like, yeah, that's what I'd say. So it's maybe less an accountability thing, more like just avoid that scenario in the first place by ensuring you have a consensus mechanism in place. Does that answer your question?
Yeah, for sure. Thank you.
Cool.
Thank you, Hannah. Thanks, Max. And with that, I would like to wrap up the How to Angel Invest Masterclass. Thanks so much for your time and everyone for answering questions.